All right. Thank you so much for joining us. We're going to have a 40-minute panel today really looking into data and really looking at the inefficiencies of ESG reporting and what might we see in the future. So I'm Nicolai Lundy. I'm the Chief of Market Relationships at the Value Reporting Foundation. The Value Reporting Foundation is perhaps going to be one of the shortest-lived organizations in sustainability ever because it was formed last summer with the merger of SASB and IRC, and it is going to be consolidated this summer into the IFRS Foundation as part of the Issb. So that is my background, but I want to make sure you know who our panelists are. So we've got, I'll just have you introduce yourselves with just your name and title, and we'll dig right into the conversation. Catherine, do you want to get started?
Hi, I'm Catherine Dolton, and I'm Chief Sustainability Officer at IHG Hotels and Resorts.
I'm Paul Simpson, the co-founder and CEO of CDP.
And I'm Anna Alex. I'm the founder of Planetly, and we're helping companies to understand their carbon footprints.
Great. Thank you. So with a mix of perspectives today, we're going to delve into a couple different conversations, but we're also going to make sure that there's opportunity for all of you to pose questions and get engaged as well. So one of the things that I want to level set at the beginning is that we are in this very fast-moving space where it is hard to keep up. Just yesterday, there was a meeting held where the SEC issued a proposed rule for disclosures for U.S.-listed companies. We had a very active discussion, just debriefing it beforehand, and there might be opportunity to get into that today. But that is just emblematic of, there's going to be things happening next week, there's things happening next month. It is very fast-moving space, and it's this contextual momentum that is starting to drive a changing consideration around the integrity of data and the practices around data. And so I want to start with you, Catherine, because you have a bit of an interesting background. You're currently the Chief Sustainability Officer, but you were the head of investor relations, you have internal audit background, you have external audit background, so you have this really rich exposure to financial data and financial reporting and the associated information related to kind of mainstream financial reporting, let's say. And so now in your role with sustainability, you have plenty of exposure to this additional information that's supplementing our understanding of companies, right? What do you think is the difference between the information, quality, reliability, integration into business processes? What's the difference you see between the financial information you've got in your background and the sustainability information that we see today?
Sure. Well, really good to be here. IHG, for those of you who don't know, we've got 6,000 hotels around the world, mainly franchised, which brings with it some complexities. But yeah, I moved over to be Chief Sustainability Officer about 3.5 years ago from being Head of Investor Relations. Obviously coming from a world where, financial data, just the controls, the processes, the standards have been in place for many years. To the world of sustainability, where, as everybody knows, it's an alphabet soup in terms of ratings, rankings, indices. So really interesting just coming in and thinking, well, actually, what are we trying to align to? Which are the ones we should take notice of? We put data in, same data goes in, lots of different results come back. So a bit of frustration, I think, there. But for me, really, it was thinking about, well, are we measuring the right things? Because that's where you have to start, right? And actually, in our industry, we've gone quite a long way. There's sort of standardized methodologies for measuring carbon and water, which has been in place for some time. So that's a really great place. And then for me, it was about, well, actually, how do then we collect that data? So we have something called Green Engage, which is a system that's been in place for over a decade. But, we get our hotels to input that data themselves. So just for me, it's about, what is that control environment? And I think that, there hadn't been that focus before. There hadn't been that focus from investors, which obviously is driving a lot of the conversation now. So for me, I think that was my main insight was, there was a lot of good work being done around data and trying to understand impact. It just wasn't as formalized. So certainly what we're doing now is looking how we can systematize a lot of that, get in some of those controls, working with our finance team and our risk team to understand how you can start to elevate that data in the same way.
So you're faced with an external environment where there may be a wide range of ratings or wide range of interpretations based on what you put out there. You don't have so much control over that, but what you do have control over is the controls you put internally and how you're thinking about preparing that information for better internal decision making at the very least. Is that what you're saying?
Completely. And it's about, what matters to us and what matters to our stakeholders. So it starts with looking at that impact matrix, that materiality, and thinking, well, actually, where do we have that impact? What is the story we want to be telling? What do we think we should be controlling and measuring and reporting on? And it starts from there. And obviously, we listen to our key stakeholders and understand what's important to them. Obviously, CDP, very important, so that's one of the key questionnaires that we participate in. So really, it's just, it's for us, it's about owning that narrative and really thinking about what matters to us as a company.
And to then take a step at looking at what other companies might be facing, I want to turn to Anna because, your work with Planetly is reaching a large number of organizations at varying levels of maturity and varying levels of data needs, and they all have their own narratives, that may not exactly be the same as IHG. So as you're thinking about engaging with the market and this question around the future of ESG data, what do you think is necessary to be able to increase the reliability and trust that internal decision makers, external decision makers can have in data that's being put out there publicly?
Yeah. So I think what, like all of us in the business world, we have a skill that shouldn't be underestimated in the whole climate crisis. And this skill is to look at some abstract graphs and figures and then act accordingly. This is what we're used to do, like in financial data every day, and this is on other data, on my marketing data, and so on and so forth. And this is a skill that we now need very much to apply to the financial crisis as well. So we need to look at our carbon data, at our ESG data, sustainability data in a wider sense, and then act accordingly. But in order to have the confidence to act, we need to have a high level of trust, and this data needs to have a high level of reliability. So if you're like calculating your carbon footprint and then it's fluctuating from one year to the next, and it's not matching, for example, the growth of your business and so on and so forth, then you start questioning if this data is at all correct. And this is very, very complex. And our take is that technology and automating the data collection process can increase the trust that you have in your data massively and actually can provide you with this one source of trusted data around sustainability, which then facilitates action around that. So it will be, going forward, actions that companies are taking is making the bonus payment depending on this data. So the data needs to be correct, right? Because there will be people sitting and saying, hey, my payment is depending on this. So I want to trust that. And I think this is where we need to go. And when we started Planetly 2.5 years ago, basically there was no alternative. There was no tool out there which was really automating this. It was all calculated in Excel sheets. And if there was some mistake somewhere in one of these big Excel monsters, then it resulted in a different figure in the end. And so I think we really, technology can provide us with stepping up our game in that sense and really get to this high reliability of data.
So if we think about the controls Catherine was talking about, where do you see technology fitting in? And maybe it's everywhere. Is it in data collection? It's in data verification and making sure that there's some sort of process to make sure that nothing got translated incorrectly. Is it in the reporting and the analysis? And we've got this graph now, and technology is helping with this. Where do you see it fitting in? What does that look like for practitioners?
So it's fitting in everywhere in the data collection, but as well then in making sense of this data and as well taking climate action then based on this data. What we definitely see is that companies who are already at a high degree of digitalization and have their data under control are much more likely to do a good job in sustainability reporting and ESG disclosure. Because and if it's a company which missed at least partly this digitalization, and they have a hard time reporting on this. So this is definitely connected.
And if I may as well,
I was going to go to you.
I was just going to say, I think in terms of, the data that is useful, there's data that's useful in the business from management reporting and action taking, and which is quite different to the data that we are reporting externally. So for us, one of the insights we had is, we talk to our hotels about carbon emissions. And, your general manager who is trying to check people in, check people out, probably cleaning some rooms, carbon is a completely alien concept. So it's about energy efficiency. It's about saving costs. So it's about, well, actually, what information do they need to do that versus then what is some quite complex greenhouse gas emission reporting in our annual report. So there's kind of we found, there's such a varying range of data and reporting needed for different purposes. It's really quite complex.
And are you in a position where some of that can be leveraged? It's the same data that's leveraged and interpreted in different ways, or it's really required different collection, different sourcing?
It's collected in one way, and then we leverage it as much as possible.
And find a way for it to actually be relevant to a hotel manager, and it's in a different way relevant to, one of your shareholders coming into it.
And various kind of ways of aggregation on the way.
Yeah. Data is your bread and butter, Paul. It's been for 20 years. But I think we could have a whole discussion on what you've learned about that. But I know that part of where your excitement is right now is this point in time that we're at. You have this long history of working in this space, CDP being groundbreaking in so many ways. But maybe what you're most excited about is the future. And I'm curious what you see going on right now in terms of increasing participation in the CDP survey, increasing disclosure generally, increasing regulatory scrutiny, increasing investor engagement on these topics. All of those point up. Do you see what point we're at right now is just ongoing incremental change? Is it just, we're just going to continue to see gradual increases, or are we at this turning point? Are we in a transformational change right now with what's going on in the market?
Lots of questions. I think we're in a really critical point. Whether it's a transformation point, it's a somewhat overused word. I mean, if you look at the past, we've come a long way in the last 20 years. We founded CDP 20 years ago because capital markets were not engaged in climate and environmental activities at all, and people said, well, get us the data. If we have data, we can think about it, we can understand the risks and opportunities. So we certainly see, if you look at climate emissions, it's a hockey stick graph. If you look at disclosure, it's a hockey stick graph. So I would say we're in the mainstreaming and institutionalization phase of ESG disclosure. And what I mean by that in terms of mainstreaming, last year, 13,000 companies disclosed through CDP on climate change, and that's up 37% the year before. So it is the hockey stick graph. And you can see that all around the world. That's more than 1,500 companies in China, where people say, there's no disclosure in China. I said, no, there is disclosure in China, more than 70% of the S&P 500 in the US. So that's a market-led disclosure. The investor requirements, which have absolutely gone from, I would say around 2015, most investors saying, well, we know we need to do something about this. Some were really actively, but then every institutional investor is cognizant of this and wants better data. So the investor demand on companies, we want good quality disclosure from you so we can understand the risks and opportunities, has really gone through the roof. And we have 680 investors with $130 trillion of assets. That's more than half the world's capital, according to The Economist, are requesting disclosure through CDP. And it's not just in CDP. We now have in the regulatory environment, we had the SEC announcement yesterday that you referred to. You have the EU. There's going to mandate, is in the process of already mandating a lot, the sustainability disclosure, the taxonomy. But in India, there is a new legal requirement. China is developing one. Singapore has one. New Zealand already has the TCFD mandatory. From the 1st of April here, large listed companies in the UK will have to do a TCFD disclosure. So the regulatory wave is really kicking in, and that changes everything because companies have gone from doing this because it's market-led to because they have to. And that means the data needs to be much better quality. So we are in this kind of mainstreaming phase. I think there are some important questions that we're still learning, right? We like to think we know what we're doing, but let's be honest, most of us in these issues and the society as a whole is still learning. So how, as you have regulation and you have the International Sustainability Standards Board that we need, and it's going to really help, create, their words, a baseline for market disclosures around the world. How do we take that but still allow some innovation? Because investors are coming saying, well, what do we need for the future? We need more. Disclosure tells you what's in the rearview mirror, hopefully where a company is today, and in a way for an investor, most importantly, is where is it going tomorrow, right? So now we see a lot more demands for forward-looking data, forward-looking metrics. So does your company have a target, emissions reduction target, a science-based target? Do you have a transition plan? What are you doing on your CapEx, your OpEx, your R&D? Show us how your company is going to change in a changing market and changing demands on sustainability. So that's where the innovation, and I think the future's coming. Everybody working on it, I think, can see that and is learning to understand it. But as we have a piece of regulation, which becomes quite a flaw, I would say, how do you then still allow the market to build that innovation and then feed into regulation in time? And the final thing I would say, this is ESG disclosure at CDP, with really environmental disclosure, but the disclosure is the foundation of a sustainable economy. It doesn't actually deliver a sustainable economy. So we've still got a lot to do to close the gap between what the science requires and what the market, where the market is, and that innovation in disclosure can really build that bridge.
Yeah, which I think is going to be really interesting to discuss in a little bit more detail in a second. But I want to zero in on one of the things that you said, which is you see this regulatory wave. And I want to see if that's how you see it and you're feeling it and you feel your peers are feeling it or not. Do you share the same perspective around what's around the corner?
Yeah, I mean, I think so. I think for any company, there is a lot going on. You know, I'm lucky that I work for a big company and I have a team who help with this. But I think that, for smaller companies, it's difficult. I think the Issb will be great because, as we hope, consolidation and consistency is really, really important. Mm-hmm. But, I am fully supportive of more regulation to drive change. But I just think it's going to take companies some time to get there because there is a lot to get on top of. Mm-hmm.
Mm-hmm. And so, Lynn, let's go into that topic that you raised, Paul, and that you also touched on, which is with a world where many or most companies are exposed to regulatory requirements for disclosure. Does it then create the conditions for competition to improve performance, drive actual better results in the market, or does it drive a race to the bottom to just meet the minimum requirements and then say, okay, we're done? Anna, I want to start with you. Where do you see the regulation waves on the horizon? It's going to crash or peter out in the market, whatever you want to describe the wave as. Then what happens next? What do you see coming?
Yeah, so I believe this is a real danger that now that regulations are actually kicking in and out there, the companies only jump as high as they need to, but not higher. So I think we all need to work on actually bridging being not just being compliant, but actually taking climate action and bridging these two factors with each other. Because, I mean, as Paul said, like reporting on all of this data is nice if it doesn't follow any action that we're doing, then it will not bring us anywhere. So then we will just report on the climate crisis, but we will not get out of it and find our way out of it. So I think what is necessary there is regulations are now starting with disclosure, and this will only be the beginning. And in future, companies will not just be asked to disclose, but as well to talk about their transition plans and their real actions and report on this as well, and report on the reduction achievements that they have over the years, and not just disclosing it and being off the line.
So you think the regulation will come and then it's just a race to check that box. Do you guys share the same view? Paul, what do you think? Yeah,
I think the regulation coming in, it creates the floor, and the floor needs to not continuously but periodically rise with its ambition, and we don't have a global government. That's very obvious, and that's a problem because we kind of have global markets, right? So capital can move across borders pretty easy anyway. Let's put it that way. So what you have is what the EU is bringing in, the CSRD, loads of acronyms, sorry, but that really will be the most high bar regulatory requirements for disclosure from in the European Union. Generally, and that's not just climate, that's covering a whole range of ESG factors. Then you've got a lot of jurisdictions, things that will go climate first. So the SEC is a climate rule. I don't think they'll eventually stop at a climate. The Issb will go climate first. So we should have a climate disclosure standard from the Issb by the end of the year. But then what's next? So some will go all in on ESG, some will go climate first. then periodically we will have this kind of increasing. I think if companies say, well, we get responses to CDP which says we comply with all regulations. I say, well, I'm glad you do that. Thank you. Did you do anything further? Right. So I'm being a bit sarcastic, but to make the point, if companies say we comply with all disclosure regulations, job done, I think the companies thought that will come back to bite them or you, because this isn't going to stand still. Regulation will keep increasing. The UK announced at COP26 it will require companies not just to disclose in line with the TCFD, that was already a coming requirement, but then to publish by 2023 a transition plan. For large listed companies, the point about small companies is very right. So these requirements, and I think it's very difficult being a company, are sort of creeping because we are learning about the crisis that we face and how the norms of the market behaviour have to change. So it's going to remain dynamic with the baseline becoming much clearer. And for global companies, it's very complicated because in different jurisdictions, there will still be different requirements. The ISSB should hopefully create a common baseline globally.
So you see the emergence of regulation at least creating a floor. You want to see that floor rise over time, but you think there will be other organizations that move the ball forward or get pushed or encouraged to go beyond that. Is that what you're saying?
Yeah, I mean, most institutional investors now are saying, we want disclosure, of course, but what do we want disclosure for? Mm-hmm. We want to assess where a company is in its transition to net zero. $130 trillion signed up for GFANZ at COP, which is a commitment that they will move their investment portfolios to net zero. How do you do that? You either sell a lot of 30 companies, or you transition all of the companies in your portfolio, which is the preferred market behaviour. So the investment community wants to be able to assess where a company is, where a sector is on its climate transition. It shouldn't only be climate. And that's what's going to drive that. Well, we've got this bit of information, but now we need this piece.
Mm-hmm. Yeah, go ahead, and then we'll come back to you, Anna.
I think from sort of the company perspective, for me, and this might be because I've got a finance background, I genuinely like TCFD because for me, it's done such a great job in engaging my wider team members in risk, in strategy, in finance, in company secretariat, in thinking about long-term impacts of climate change. That conversation hadn't really happened before in that way. And actually, our group executive committee is meeting this week and discussing this. So it's actually really, for me, it's not just about the floor. This is stimulating, because it's looking at risks and opportunities, it's just started that conversation in a different way. So actually, I think, TCFD was such a positive move in order to get companies just having a different type of discussion, embedding risks and opportunities from climate change and not just about reporting the numbers.
I'm glad you commented on that because I was going to get a sense from you. There's plenty of organizations that are already engaging in sustainability management and sustainability disclosure independent of regulation. And so you have, your own perspective and probably lots of your peers that would continue doing something in the presence of regulation. But with the role of TCFD, you're going to be very happy with the ISSB exposure drafts. Those are expected in the next 2 or 3 weeks. I don't want to say a date in case it goes one day off, but there's a date it'll come out. And, there's actually going to be 2 sets of standards that come out. It's both the climate exposure draft for public comment and then the general requirements exposure draft, which sets out the disclosure of sustainability requirements that don't have an existing ISSB standard and then working towards increasing ISSB guidance over time. But Anna, did you want to come in? I thought I saw you flagging something and I didn't want to move past it.
Exactly. Just one thought. So I think finally all these regulations are coming into place is a good thing, of course. And it is, as you say, raising the bar and the downside protection is so there is a lot of upside potential still, which is much higher than just being compliant and meeting this. And the good companies already got this today. The good companies are tracking their emissions for years, like the Economist, right? And they understood that it is critical in attracting talent, in being able to participate in a tender, being able to have the license to operate, basically. So, and this is not going away, and it needs to lift over time. A certain part of this will always stay voluntary, and there will be first movers which are pushing this forward.
So I'd be curious to delve into a couple more things, particularly this, future horizon around thinking about more clearly articulating where management of sustainability issues more directly ties to impact on the financial statements, whether it's asset value, overall cost of capital, things like that. But that may not be exactly what people are curious on. So I'm just kind of flagging that I may come to you on this if we get no questions, but maybe you're hoping we get questions to avoid that. Anybody have questions? We've got plenty of time, but want to just open it up in case people do.
We've got 3 questions on slide, 4 questions.
Lovely. And so you'll read those off. Thank you.
So our first question is on practically what can companies actually do to tackle inefficiencies outside of digitalization?
Outside of digitalization. Well, I might have a perspective on that, but let's start with you. You're in the weeds on this.
For me, the first step is just communicating internally to stakeholders why this data is important. So I think there just isn't a wide, we started off by kind of going, we're talking about wider ESG data here, collecting data from different departments. And they're like, really? That's a whole load of work. It's like, yeah, no, but it's important to a wide range of stakeholders, I think. So just helping people to understand it's not just your investors, it's also customers increasingly. For us, a lot of our B2B customers are now demanding this type of information. So I think that's a really big point, is just articulating why it's, outside of digitalization, why it's necessary to get this data right and have mechanisms for reporting it.
One of the things that we sometimes hear from organizations is that it's really helpful to find voices or resources outside your organization that you can use to leverage attention inside the organization. And that is, in your case, like TCFD, saying, here's an opportunity to engage people who aren't engaged in this conversation, or it could be, anything that might be coming out from regulation or the Issb standards, or even leveraging, the outcome of the CDP survey and saying, shopping it around internally to say, is this something that we can engage on? Because sometimes you can deliver the right message internally within an organization, but it might be even easier. Even call up some of your investors and say, hey, I'm really trying to get the message across to our management team or our board, and want to understand how you think about ESG and how can we get that message across internally. So sometimes it's finding messengers outside the organization that can help as well, or resources outside the organization. Let's go to the next question.
Further question, one from Aaron Morales. Should companies invest in people or in technology to assess reporting fatigue and enhance ESG disclosures?
Or, what a black and white decision here. Anna, I will be curious what your answer is going to be, but let's start there.
So with our platform, we see actually us supporting through technology the job of the climate officers, the job of the head of sustainability, CSOs, however the title is. We can make them successful. We can support them by having the data at hand in the moment that they are asked for this data. In the moment that the CEO is asking for this, they can say, wait a second, here they are. Here's the answer on this. So I don't think it's a or question, it's an and question. It needs to get together and it belongs together a lot. And maybe additionally to this, like what we need to do over the next few years is so big, and there are only very, very few really educated people out there who can take these jobs and take on these jobs as like sustainability officers or climate officers internally. So we definitely need technology here in order to like leverage the knowledge in the market and support them looking at the right things and then getting the right action from that. So I think it can only go well together.
Go ahead.
I very much agree with that. It has to be an and. I started my career as an investment analyst. So you have a lot of data, but you have to understand the context of the data, right? Emissions have gone up 10%, water use has gone down 20%, profits are, why, right? Now, technology can turn data into insights because insights are ultimately more valuable. But we also need the stories, right? Well, we did this, and this is why. And one of your hotels does something. The manager's really proud. Then next year, all the others are copying, right? So we've got to, data is again the foundation of informing human or business behaviour. But it's not only about data. So we've got to have both.
And this is not what you're looking for, but what I would say is that they solve different problems. Technology is going to help you improve trust and reliability information and access the information. You know, a spreadsheet stored on somebody's desktop isn't as accessible as a dashboard that everyone can log into, right? But people are going to actually help turn whatever you learn from that into action, into plans, into improvements. So I think they solve different problems, and that's why I don't see it as an or either. But it's maybe not helpful for the person asking for budget for one or the other. Go ahead with the next question.
So this is a question from Marina. Science has shown us planetary boundaries beyond carbon and climate, nature and water, biodiversity and chemicals. When will this be reflected in ESG reporting?
Anyone wants to go? Go ahead.
So, you know, CDP, we started on climate, then because companies told us more than investors, being honest, then expanded to water, and then forest, which is really looking at deforestation in supply chains. If we want to have a sustainable globe and a sustainable economy, sustainable society, we have to tackle all the planetary boundaries. Now, that's a headache because there are 9 of them, if I remember correctly. This is all the science that Johan Rockström and others have put together. It's really insightful. So, you know, we are now expanding on biodiversity, on land, and CDP is just at the moment the E of ESG. But we see with the EU requirements will be broad. Certainly the Issb plans to expand into other topics, into more detail, biodiversity, etc. So it's a tough thing to sit here and say we're going to have to do them all. But if you look at planetary science, we do, because it becomes interchangeable. 15% of deforestation, the deforestation creates 15% of global greenhouse gas emissions a year. The oceans are storing and emitting CO2. The system is completely interrelated, right? It's much easier for us to say, let's just tackle one topic and understand that. But the science, and I'm not a scientist, is going to require us to look holistically.
Anybody else want to chime in on this? So I would say that, you know, there's already some guidance in thinking about how to report towards planetary boundaries, but I think the question is, when are we going to see that in practice? What I would say is that there are going to be some markets, some jurisdictions where regulators are just not going to ever require disclosures related to planetary boundaries because it's just not in their legal remit or their purpose. That's unless you see a change to those legal remits and purposes, which could absolutely happen when we have this doomsday scenario and governments are like, we have to change, you know, the legal requirements around how we think about this. But that's not going to happen in the next few years, right? And so I think that you're going to see increasing uptake around disclosure around planetary boundaries when you see this baseline of disclosure met that is either, you know, a baseline focused on how sustainability impacts enterprise value, which is what the Issb is working on. There's not really going to be significant information or key information related to planetary boundaries, or you start to see other initiatives to take that broader and use the building blocks upon the baseline to go beyond that. You might see those initiatives come out of a broad uptake. When you see lots of companies disclosing a baseline of information, then I think it opens the doors for some organizations will want to be leaders. And then they'll start talking about how their operations fit in the context of planetary boundaries. There's a lot of education that's needed to get to the point where you can have companies comfortable with that. But I think that once you have a lot of organizations meeting a baseline of disclosure, others are going to want to differentiate themselves. And then you start to see them disclosing on their performance relative to planetary boundaries, and then it starts to pull the whole market along. That would be my guess on theory of change, in addition to where some markets, the regulators may be very forward-thinking and wanting to actually see disclosure related to that. But plenty of markets, a lot of the large capital markets, just what we know from the remit of regulators, it's just not going to come that route, would be my, you know, proposition. Go ahead to the next question.
We have a question for Catherine. How have investor expectations changed on reliability/data quality, and what are the main expectations for the coming years?
And if I could add to that, do you get questions about data reliability from investors? But start with that.
I mean, I think my first observation would just be the level of questioning from investors. When I was head of IR, you know, anything to do with ESG was probably directed by the ESG analyst at my team or I. It would not be a main, you know, the main fund manager asking the CEO or the CFO. That has completely changed now, which is fantastic. I think in terms of the quality of data, we don't get asked about that. And that's kind of like, I'm thinking you should be asking companies about that. And I think I'm not sure how widespread the appreciation is that the controls aren't in place in the same way for sustainability data as financial data. So I would expect the level of questioning certainly to increase as companies are expected to meet some of the ambitious targets that they've put out.
Well, and it really raises the question around assurance and attestation, which is a growing practice, but kind of to the surprise of many, certainly to the surprise of some of my colleagues, the SEC rule actually expects or proposes expectations around attestation. And certainly you're starting to see that come out of Europe as well. So that's going to probably just change the dynamic and dialogue around data quality. Do we have other questions? One more?
We have one final question here. So where is the opportunity or competitive advantage in transparent, advanced ESG reporting? Or is it purely regulation and compliance that has staged mainstream?
Everybody might have an answer here, but let's see. Do you see a competitive advantage with transparent disclosure?
I think mainly from that customer perspective, as we start to see, a lot of B2B customers asking for data and making choices based on that information. So we're starting, it's not being mandated yet, but as a lot of consultancy companies have net zero by 2025 targets, I think they're going to start to mandate that their people stay in hotels with, a certain footprint. So I think there could be some competitive advantage from that perspective. But to be honest, the whole industry has got such a long way to go. There's so much to collaborate on. That's really my prime concern.
Paul, do you have a perspective here?
Yeah, I think actually we're getting to a point, are we really there yet, where there'll be a competitive advantage for being, it's a very general word, more sustainable, right? Or further along your transition to net zero. From investment, that's like, are you reacting ahead of regulation to manage the risk and seize the opportunity, right? Tesla is one of the most valuable companies in the world. It's not actually a very big company in terms of number of cars going out of the thing. That's because it's seen, electric vehicles are the future. So investors are valuing the pioneer in electric vehicles. It's got some wonderful technology, but every automaker is making electric vehicles now. So it's really about actually taking the steps to be more sustainable ahead of the pack and then being transparent about it, than transparency itself necessarily being a comparative advantage. I will say that there is, at least in debt markets, you can get a lower cost of capital for providing more disclosure. And there's very good evidence of that through CDP and others. So there are cost of capital benefits.
Do you have a thought about that?
Yeah, I would actually add the factor of attracting talent. It will be simply more like sustainable companies will attract better talent in the market. And this is absolutely crucial in this war of talent that is going on. And this has been even intensified through the pandemic, because now companies are hiring just globally. And so the war of talent is really going on. And the talent wants to work for companies that are sustainable to a certain extent, that have a climate strategy in place and that are doing their ESG reporting. So I think the Google CEO very well put it. He said, companies which are failing to become sustainable will fail to attract talent going forward. And I very much see that.
And I would just briefly add that I think there's this huge dynamic to the old saying, what you don't measure, you can't manage. Just the fact of collecting the information, reporting it, even internally, means that you can improve performance and manage against those outcomes. But the transparency and public disclosure starts to come in with the accountability and it being held, creating expectations for improvements over time. And if you believe the research out there that improved management of these issues leads to improved financial performance, I think that's how you get to improved competitive advantage. But we have run out of time. Please join me in thanking our speakers for this panel.